are so many different ways and so many different tools that they have to create that. I don't really want to call it liquidity because it's just money printing, right? And giving it to the banks to support them. Yes, every bank, including every central bank, is deeply underwater. It's like all we see is the very tip of that iceberg, but the danger lies in what we do not see. And that's held really privately underneath that water. It's all about interest rates, right? And what I find really interesting is that all of this money printing and all of this money creation has essentially, there's no value in the currencies anymore. So that's not a new thing. And it's not just the US dollar going away. It's actually the entire financial system that has to reset into that new system. So taking away any stigmas of bank borrowing, but they are all insolvent, every single one. And it's really simple. Actually, I have it right here with my sterling silver chopstick. This is the principal value of the bonds. These are the interest rates. So for 15 years, they held the interest rates at zero. So any of the bonds or debt, so mortgages, auto loans, student loans, credit card loans, any of the debt was inflated. Its valuation was inflated. Then once that has reversed, so 22 and beyond, we'll look at the principal value of all of that debt now. If they are forced to sell because of a lot of withdrawals from the banking sector, we saw those regional banks collapse. There have been a number of regional banks that have collapsed since then. NYCB, that was just bought by Steve Mnuchin, one of the benefactors and the consolidators from that crisis back in March. And that's private money, right? He came in, we've been talking quite a bit about the private money, and he came in and bought that bank. I'm talking about buying talk. What have the central banks been doing, right? They've been buying up all of this government debt with interest rates at zero or even negative. So now that the interest rates are pushed up to quote unquote fight the inflation, all of the valuation of all of that debt is way underwater. So in commercial real estate, it's not just commercial real estate. Certainly, we're watching a lot more buildings being given back to the lenders. But if the valuations of all of the banks, including the central banks, are based on debt, which they are because the entire system is based on debt. This is a debt-based system. Those interest rates have pushed down the market valuations of all of that debt, not just bonds, not just mortgages, but it's also auto loans, student loans, credit cards, and then all of the mountains, trillions and trillions and quadrillions of derivative bets against that debt or against that credit quality. So yes, every single central bank, every single commercial bank, community banks typically do not take those kinds of risks, but they're sitting with all of that commercial real estate, other real estate that is at nosebleed level, multifamily, single family. All of that debt is underwater. All of it. It's not just in the US. Every central bank has been supporting their government spending by buying the debt. That used to not be the case, right? The US, as the world reserve currency, created an artificial market for US debt and US dollars. But the reality is it was a coordinated, synchronized methodology, dropping interest rates to zero after the financial crisis, or as the financial crisis was unfolding in 2008. Well, all of that debt, it is really pretty simple. All of that debt, if this is the interest rate and this is the market value of the bond when it's issued, right? So if interest rates go down, the market value of the bond goes up. If interest rates go up, the market value of the bond goes down. And on a global basis, you basically had all central banks following that same game plan, whether they went negative, whether it wasn't quite at zero, But now you're watching as they're raising the interest rates, it's the market value. So if they're forced to sell, like we saw with Silicon Valley Bank, et cetera, that's when you discover it. Because like Bank of America said recently as well, we're just going to hold them to maturity and then they will mature at par and we'll get our money back. So that's okay. Well, it is as long as you're not forced to liquidate. This year, I believe we will definitely see even more banks collapse. What they're trying to do is engineer a soft landing. But the problem is that we are transitioning into a new system. So there's no such thing as a soft landing. They need a crisis. So I think we will see even more banks collapse this year. The smaller ones, and then they will be absorbed by the larger ones. Though I think it's going to be interesting to see what private equity does with these opportunities. Should never let a crisis go to waste. Very tiny prior to the crisis. But once they had access to all of that free money, you can look at the graphs on the growth of private equity, and that's huge. And so definitely inside of the banking sector, we're seeing it. And hey, Steve Mnuchin did that the last time during the banking crisis with IndyMac, which had a ton of mortgages. And they changed the name, but they were known as the Foreclosure King, which he does not like that title, but that is what happened, not even giving people the opportunity. I think that this is significant because, again, now he's talking about buying TikTok. So private equity means a greater shift of those assets into the few hands, into that 1% or the 1% of the 1% hands. And isn't it supposed to be that, according to the World Economic Forum, we own nothing and we're going to have to rent everything from these private players? So between your big tech companies that know everything about us, right? And whether it's the private players or the tech companies, this is an awful lot of power concentrated in just a few entities. What kind of control? To be perfectly honest with you, when you look at the revenues that these entities can generate, private equity doesn't have to report as much as the other entities do. But when you're looking at the power that they wield and the assets that they're buying up, it gives us a lesson, actually, because they have the ability to do that because they have the ability to gather cash. That's what gold does for an individual. It enables you to hold your purchasing power so that when those income-producing assets that are currently at nosebleed levels, when those collapse, and we are looking at a real estate collapse, and not just commercial real estate, but we're also looking at it in multifamily real estate, and we're looking at it on a global basis, and even the price levels of the single family homes that, the younger people have discovered the American dream doesn't really exist. Real estate is a key asset for most on a global basis. So again, this is a global issue, and we're watching the real estate market implode in other parts of the world and coming to a theater near you. We're going to see that in this country too. What all of this technology enables is tokenization or assets to be turned into tokens of everything, anything that's tangible, including a glass, including the clothes that you're wearing, absolutely everything. And then what do? You hold all of this on your phone, and how easy is it to spend? Because basically the whole world has become consumer driven, because there's really, who else is going to support it? All that wealth has already transferred. Now the key piece here, and what I pay attention to very closely, is the risk transfer. Because once they have made enough risk transfer from the few to the public, to the many, then you will see that maintaining and propping up this system has just gotten too expensive. And all of a sudden, that's when you'll see the stock market crash, the real estate market crash, the derivatives market. That's the one that continues to scare me, because we don't even know the value at risk. And every single key player, the Bank for International Settlements, the IMF, in this country, the FDIC, the Fed, I don't care what entity, the World Bank, every single one of them tell you that the market value of these contracts, nobody has the true understanding of the true value at risk. That's the one that when there is an obvious explosion there, because remember, that's under the surface. We can't see it. That's an opaque market. That's the one that scares me the most, because that will easily overwhelm the central bank's ability to print their way out of it. And not only that, it's that confidence piece that there's just one little layer of confidence left, and that's the public confidence. And that is eroding really, really quickly and has eroded in other countries, just not quite in the US yet.